What's the current status of the Web3 ecosystem?
It's a very bad situation, actually. So there's two levels to this problem. Level one is
Meet Sergey Nazarov, co-founder of Chainlink, a true blockchain visionary working to upgrade Wall Street with decentralized technology, setting the stage for one of the most transformative advancements in blockchain and finance.
like in New York, like you can throw a rock, you hit somebody who's happy to take your money to invest it.
Now, as the driving force behind Chainlink, Sergey is bridging the gap between smart contracts and real-world data. He is revolutionizing trust on the blockchain and empowering developers to build the next wave of decentralized innovation.
I think people underestimate how powerful it is that a government decides to support a technology. So it won't be about 100, 200 billion, it'll be trillions. So what Chainlink does, Chainlink is a set of standards that developers can compose into complicated, advanced blockchain transactions.
There are certain expectations going forward, but what's your expectation going forward?
In my opinion,
Sergey, what's the current status of the Web3 ecosystem?
I think it's in the process of going mainstream now. I think enough people have cryptocurrency that it's a big enough market to attract the attention of the biggest banks and the biggest asset managers. So you have the financial system now going after the public blockchain market because it's a $3 trillion plus market that's set to grow well beyond 3 trillion. I think you have demographics that are more used to crypto growing into a stage of purchasing power. So millennials and Gen Z are a good example of kind of generations of people that are more used to cryptocurrency and more understanding of what it is. So approximately 10, 15 years ago, when the blockchain industry started, the millennials and Gen Z folks did not have the purchasing power that they have now as a generation, right? So there's a general large market trend for the amount of value in the public blockchain industry. There's a generational shift, and people talked about this generational shift with me like 10, 15 years ago. And if someone says to you, in 10, 15 years, there'll be a generational shift, it'll change everything. It all sounds a little bit far-fetched because they're talking about 10, 15 years from now. But I think that's definitely happening. And now I think the big piece that's falling into place is that the regulatory landscape, so essentially the government, is going from being a net negative to a very large net positive. So it's not going from net negative to neutral, right? You're not going from a world of negativity to we just won't bother the industry. It's now going to a world where the government is going to actively accelerate the adoption of blockchain technology, cryptocurrencies, real-world assets, tokenized funds. And that's actually very, very significant because this is the U.S. government, right? The U.S. government has control of the largest financial system in the world. This is why so many other regulators follow the guidelines of the U.S. Financial services markets and the regulators there. It's because they want to meet those guidelines for their economy to interact with those markets, right? So it's actually pretty significant that all these three trends are coming together, right? You have a large and growing market, wherever that money's coming from. You have a trajectory to have even more money flow in because the user base, the retail user base, is from a generation that understands cryptocurrency and is skeptical or more skeptical of fiat currency and more skeptical of traditional financial systems because they went through or heard a lot about the 2008 financial crisis, right? So that heavily influenced the millennial and Gen Z generation to be skeptical of more traditional financial systems, and I think leads them as a generation to be more open to alternatives to the traditional financial system. And now you have the regulation and government entities managing that regulation, pushing. So they're not slowing it down. They're speeding it up. This is like, it's a little bit hard for people to understand what this looks like sometimes because they haven't seen it always in other places. So this has already been the case in Singapore for many years with the Monetary Authority of Singapore. The HKMA, the Hong Kong Monetary Authority, has also been doing this for many years. Dubai has been doing this for many years. And last year I spent, the majority of the year, hundreds of days in these other places because they had a very progressive regulatory regime. And we've announced multiple implementations in the MAS Guardian framework. And with the HKMA, you've seen us get on stage and talk with the Undersecretary of Financial Services of Hong Kong and others from that regulation kind of regime, that regulatory regime. So I actually know and have personally seen and dealt with what it looks like when the government is very pro-crypto. I literally spent last year with almost all the pro-crypto governments of a significant size, with their central banks, with their regulators, kind of coming up with ways how CCIP can help interconnect all those geographies and how to build better stable coins with proof of reserves and all these kind of projects we've been doing with them on an ongoing basis, some of which are public, some of which aren't. And so it's very, very powerful. I think people underestimate how powerful it is that a government decides to support a technology. I think the next stage after the government supporting the technology will actually be the government adopting the technology themselves. So you'll start to see things like the U.S. Treasury and other departments of the government start to adopt blockchain technology themselves, similarly to how they adopted web technologies. Like they all had to get operating systems, they all had to get servers, they all had to get personal computers for their staff. All of these things, the government had to adopt at some point. So right now, the state of Web3, I think, is basically as bright as it's ever been. Not only because of the current market size, but very importantly, because of the dynamics that promote an increasingly larger market size, right? And as the people that have been in this industry for even a moderate amount of time know, it is really the market size, the continued influx of value into the blockchain format, in my opinion, whether that's public or private, that drives the industry's growth. And so the industry is relatively large, but the universe where it can grow, like the universe it'll grow into, the market size it can grow into with all these dynamics I've just mentioned, is much, much larger than this. So it's actually, in my opinion, the brightest time that there's ever been in the blockchain industry.
Well, I mean, you and I have been in the space for relatively a long time. Personally, I've started at the beginning of 2017, and it feels like there is some sort of perfect storm where, of course, Asia has been proactive when it comes to adopting Web3 and crypto and blockchain. You mentioned Dubai has been doing the exact same. While in the meantime, we still had the US rejecting the adoption of crypto through the previous administration, which is a complete U-turn at this point. So why does it feel so real at this point that we are actually going to have the actual adoption of Web3?
I think because so many large entities are switching from saying it's bad to saying it's good. I think there's enough large brands like BlackRock, large banks, now the US government effectively endorsing the technology as a net positive. So I think the message has significantly changed from, no one believes in this, to everyone believes in this, or like all the smartest people believe in it. And soon enough, all the other people who follow the smartest people will believe in it. And the other, that's basically it. You just have like a big shift as of last year with BlackRock, other large asset managers launching tokenized funds, the rise in the crypto price, the government of the US, being decidedly pro-crypto, pro-blockchain now. the president making a coin. Like these are pretty big, pretty well-known endorsements of the technology that even like 2 years ago, if you told people, oh yeah, the president's going to make his own coin and all the biggest asset managers are going to make their own tokenized funds. Yeah, that's what's going to happen. You would have been like some guy in a forum that people make fun of, right? That's probably what, the category of people you'd have been in. So I think that has shifted. I think the piece that's still missing is the user experience. But now that this is so popular, the user experience, I don't think will be as much of a problem because so many traditional web companies will offer crypto things. So you already had Robinhood and PayPal and a few others offering access to blockchain assets and crypto assets. But I think we're going to enter a world where tokenized funds of all kinds, private equity tokenized funds, money market tokenized funds, whatever flavor of fund that you want is going to be a tokenized fund. And then also the ability to access, either through ETF structures or direct ownership, various cryptocurrencies, including meme coins, NFTs, once those become sufficiently regulated in a way that the large institutions and fintechs can interact with them. So I think there's all this endorsement, and there's still a little bit of a ways to go on accessibility, on like the ability for a user to very easily acquire some of these assets. But I think we're going to be in a world where a blockchain-based asset is going to be better than a non-blockchain asset. That's kind of the world we're going towards. And once that's regulated in a way that people are comfortable with, like the fact that traditional assets have regulatory protections or are safe for large institutions to deal with, that's kind of, one of their last positive characteristics. That if that characteristic is acquired by blockchain-based assets, you have all the positive blockchain-based characteristics and, like 24/7, 365 markets, better settlement times, less fraud risk because it's secure, like 50 other things. And now you have the guarantee of a government backing that asset. So I think the fact that we're on a trajectory to that, like a very clear, obvious trajectory to that, creates a very different impression in people's minds. I think it's still undervalued how important that is, actually.
I think you touched upon a few points where indeed the president has created its own crypto or meme coin. We also have a family of the president providing, you can't give financial advice, but on the day of the largest liquidation in history for crypto, they are out there tweeting about what they're doing themselves. And then, by the way, you mentioned the 24/7, 365 markets. The CBOE just came out that they would like to propose an idea to open up the stock markets for 24/5, where 24 hours a day, well, basically, technically already have this, but the news just came out. And then I think on top of that, the user experience within Web3 has changed a lot too, where, of course, in the previous cycle in 2020, we had the big surge of DeFi 1.0, or whatever you would like to call it. How has that changed in the past few years?
DeFi, in my opinion, its value is heavily driven by the ability to provide yield. Mm-hmm. So fundamentally, DeFi grew because it provided an outsized yield on cryptocurrencies and in many cases for a decent period of time, the US dollar. And therefore it was a lucrative alternative for both holding crypto in DeFi and holding US dollar denominated stablecoins and other fiat coins in DeFi, right? What is one of the main roles of a financial system. It's basically to provide yield, right? Returns against a certain profile of risk. That's basically what the financial system does, is it allows people to gain a return while managing risk, right? That's the function it serves for the majority of its users. And DeFi, in that lens, created a superior return at arguably a lower risk, right? Some people would say it isn't a lower risk because you have things like Terra happen, but and FTX, which isn't DeFi, right? Which is some weird version of CeFi. But you basically have another group of people that say, hey, I can get 8%, 10% on the US dollar or more when I can get 4.5% in the traditional system, so I can double the amount of yield I get on the US dollar. That's enough of an inducement or an incentive to really understand what the risk is. I mean, if it's 0.5%, it's 50 basis points, or if it's like 2%, that's maybe not enough of an incentive. But when you're doubling the yield you get on an asset like the US dollar, which is a very commonly held asset, yeah, that's enough of a reason for a large percentage of US dollar holders and treasury holders to ask themselves, should I put that value into DeFi? Similarly with the tokens, maybe I'll get a certain amount of yield in DeFi that I don't get in CeFi. And realistically, DeFi, in my opinion, is less risky than most of the crypto CeFi systems, because in most of the crypto CeFi systems that like give you whatever they give you, 15 or 20 or whatever percent, you just have no clue what they're doing, right? They can be day trading, they can be a Ponzi scheme, like you just don't know, right? With DeFi, you actually know what's going on because you can evaluate what the status of the assets are, what the liquidation thresholds are. All these things are very public and very, very easy to evaluate. So I think what it boils down to for DeFi's first boom was the yield. And what it's going to boil down to for the second boom, which I think is happening now, is the yield together with the ability to prove a low level of risk. So the real money in finance, I think, comes when you can provide yield, returns, a rate of return with a predictable, clearly defined, measurable, manageable level of risk. And so if DeFi provides doesn't have to do double, right? These two things, these two forces are always in conflict, right? How do I get a return without the risk, right? And so if DeFi can convince more and more of the financial system, more and more of the traditional banking user base, more and more of the sovereign wealth funds, more and more of the asset management community, that it is actually a reliable, largely de-risked place to put money, and it offers you 2% more money, more return. I mean, a lot of the stuff in the financial system, people are fighting over 10 basis points. People are fighting over a fraction of a percent. And that fraction of a percent is like their whole profit margin for their whole, asset management business. And we're talking about multiple percentage points of additional yield, right? So that's a lot of value to create an incentive. The problem is going to be, can I legally put my money, my client's money, or my fund's money, or my sovereign wealth money into a DeFi protocol? Is that, somehow legal according to certain regulatory guidelines? If the answer is no, okay, that raises the risk. If the answer is yes, it lowers the risk. And then how do you evaluate the actual risk of the entity that supposedly holds the capital? And how do you evaluate the technical risk? And this is one of the unique things that DeFi can do that many other systems can't do, is DeFi can basically say, okay, you can evaluate the entity risk of Aave. Here's Aave, and the Aave DAO, the Aave community, all this Aave stuff. But actually, that doesn't really matter that much because you have these smart contracts that only work in very, very specific ways. And so if you believe in the security of a specific blockchain like Ethereum, and if you believe in the security of specific contracts that, have a specific way of doing liquidation and giving out yield and so on, your assessment of the risk of the brand of Aave or of some other DeFi protocol actually will, in my opinion, be less important. So if you have legal protections and you can evaluate the technical security and the technical guarantees, and you can understand that the technical guarantees supersede the brand risk, like the brand risk of a DeFi thing should be much less than the brand risk of a CeFi thing, because the CeFi thing can make all kinds of choices about your capital and the risk to your capital that a DeFi thing just can't make. That's the thing that people don't understand yet still. Once they understand that, and if the yield is high enough, then DeFi, I think, will be eclipsing most large banking infrastructures in the trillions. So it won't be about 100, 200 billion. It'll be trillions. And it's very simple, right? It's just, does DeFi give me a higher rate of return with the same or lower risk? Like, what's the answer to that question? The answer is, yep, it gives you 2 to 3% more yield with equal to slightly higher risk. That's a multi-trillion-dollar answer to that question. But I think that's what DeFi needs to do now. I don't think DeFi providing 30% yield is going to do it this time. I think it's going to have to be, 10% yield, but with very, very good risk management and risk controls, and ideally regulated legal guarantees that make it safe to put your money into DeFi from a regulated point of view. I think that could make DeFi maybe even the preferred place to get yield from the financial system.
I think I completely agree on that, but that also means that there is a different target audience to use DeFi in general. And in the previous cycle, when the technology advanced, it had a very crypto native Web3 yield hunter perspective that didn't last. And of course, if you have a very high yield that you provide on a DeFi protocol, it's not going to stay there. But you're touching upon something interesting there, which I think recently the target audience has opened up in the US, as Jerome Powell has been stating that, or they have been reversing SAB 121, in which banks are now perfectly able to provide custody for crypto assets or Bitcoin. Now, if you understand that perspective, including your previous answer, what's next?
I think what's next is that the financial system and the traditional financial equities in the system become the interface provider for blockchain-based assets like tokenized funds, which is basically the reformatting of the existing financial system. And they also become the interface through which you acquire large amounts of various cryptocurrencies, whether it's in an ETF structure or whether it's in a tokenized fund structure. But the problem of taking people's money to make an investment is not really that big of a problem. That's not the problem, right? There's entire large entities that are multi-hundreds of years old. There's fintechs, PayPal, Robinhood, all these fintechs out there that are, Wealthfront, all these systems that are more than happy to take your money and manage it for you as a consumer, right? So there's already a huge universe of give me your money easily places on your mobile phone, in a physical location with a bank, at an institutional premium private client level with people, with free water and fruit and nice chairs and like beautiful views and like please come in and speak with us about your financial plans and shit. It's it's not a problem for people to take money from other people to invest it, right? That's not an unsolved problem. Like in New York, like you can throw a rock, you hit somebody who's happy to take your money to invest it. Um, so the problem is, what are they invested in? What is it that the money's going to flow into? And a corollary to that problem is, what are the systems that control that asset, that control that money, that make sure that the asset and the money are safe, right? What are the payment systems? Okay, well, the payment systems can be really slow, so there might be fraud, so we have to pay a larger fee for the payment. Or the asset management systems, they have these custodian vaults underground with pieces of paper in them. That costs money to maintain. Someone has to pay for that. Eventually, the consumer pays for that, right? So there's two levels to this problem. Level one is, how do you make a better asset that works better, is more secure, is less costly to operate, reduces risk, provides better yield, which is what blockchain-based assets are better at than traditional assets. And then the second problem is distribution, right? How do you get that asset in the hands of people? The problem of distribution is not that there aren't enough people or entities or companies to take people's money. The problem is that the asset that you just made, the crypto asset, is not an asset that those people are comfortable or able to sell, right? This is the transition we've seen over the last 5 years, right? Where it's like 5 years ago, you would go to every bank and you would be like, will you ever offer your customers cryptocurrency? Bank would say, no, we will never do that. That will never happen, ever. Just won't happen. Maybe not 5 years ago. What is it? Yeah, probably 6, 7 years ago, actually. Maybe 5 years ago, some of them might have said maybe. Most of them would have still said no, right? Now, if you're a bank and you don't offer your clients the ability to own crypto as part of their assets or part of your services to them, something's wrong, something's strange with you. Like you are missing something as a bank at this point in the game if you don't do that. So what's it going to be like in 5 more years, right? If the past 5 years everything was moving at the speed of a crawl, with the world's governments and regulators trying to slow it down at every stage, except for like 3 to 4 regulatory regimes in Singapore, Hong Kong, Dubai, and 1 or 2 other places. Well, the next 5 years should move pretty fast relative to the last 5 years, right? Because now all of these platforms that can take people's money can give them access to blockchain things. That's the thing that's going to change, right? And at that point, the user experience of crypto kind of matters, kind of doesn't matter as much anymore. Because if you don't have to go get a private key and remember a seed phrase and remember, how to store the seed and remember, how to log into the private key and remember, what an address is and remember to check your address and remember to do all this random wacky shit that like people don't like to do. Maybe you just log into your existing systems and you just buy a tokenized fund or you just buy crypto because it's easy and it's something that everyone is comfortable with. That is the next stage. I think eventually we'll get to a place where people do more self-custody. And I'm a fan of people, taking their own security seriously and so on. But generally speaking, I think that user usability, kind of user flow problem of crypto, where it's very hard to deal with it, is going to be reduced. I mean, there is double-digit like amounts of custody and tokenization solutions, right? Like just to name a few, Fireblocks, Taurus are good examples of very robust solutions that are getting adopted very widely. So yeah, like all of the blockchain assets will be better than the traditional assets. They'll also be legally allowed in the same, or legally protected in the same way as traditional assets. And the barrier to own those assets will be lower. So why would everything not migrate into these assets? That's like the actual question. I asked this question to people once I explained this to them, in the banking sector, in the asset management sector, in the financial market infrastructure sector, in the central banking sector, now more and more in the government sector. I mean, once everyone understands the situation, they're not like, I've been explaining that for well over 8-9 years now. Once the situation becomes illuminated, I don't really hear many good reasons why everything won't become a blockchain-based asset. I think the problem is many people just don't understand the situation yet. Like, the situation is not super clear to them. It's very, very clear to me, but like for some reason, there's still an aspect of the situation that, like, they think there's some blocker. They think that it's like, it's going to be that the user experience is always going to hold crypto back, or the regulation is always going to hold crypto back, or the banks will never adopt crypto because the banks are afraid of crypto, or some other stupid idea, right? But all of those ideas make no sense, because I can literally take each one of those and say, nope, the banks want to adopt crypto because their customers want it. Nope, the regulators want to adopt crypto because the government decided that's what they want to do. Nope, the user experience doesn't matter anymore because there's a million entities that want to take people's money and give them assets in return, and they'll just give them these blockchain assets in return for the money. So like, what else you got? Like, what other reason could you possibly have? And yeah, I just don't see a reason why it wouldn't happen with all these factors heavily in its favor.
I think there's of course the legal hurdle that we had in the US, or at least the regulatory hurdle that we had that was pushing back crypto in terms of adoption. I think that's a key component. And I think the second component is, if you have TradFi versus DeFi, is that, for instance, my parents, I mean, if you go to DeFi nowadays still, or like most of the protocols, you need to install any third-party wallet that connects to any protocol where you can deposit your funds, or it's still, every step you need to take is relatively complex still for the order.
I totally agree with you, but what I'm saying is that your parents will be using Aave through their bank.
Exactly, yeah.
That's basically the point. The point is that your parents and your other relatives who like have their money on their mobile phone in some like mobile phone wealth manager or something, they will now just have a new category of assets or yield bearing instruments that it might not even be called DeFi. I don't even know what it's going to be called. But at the end of the day, it's going to flow into these blockchain-based protocols and assets. So your parents won't have to deal with it, is my point. Because the banks and all of the providers of everyone's asset management software and tools, whether that's a mobile tool if you're Gen Z, or whether that's on your PC if you are a boomer, or whether that, wherever it is if you're a millennial, you won't have to do all the DeFi stuff. No, nobody really wants you to do all the DeFi stuff. Like, the DeFi protocols don't care if you do the DeFi stuff. The banks don't want you to do the DeFi stuff, like all the DeFi steps, right, that you described. The consumer doesn't want to do all these steps. The only thing the consumer wants is yield at a certain rate of risk. The only thing the bank wants is to provide that yield to the consumer for almost de minimis level of fees at this point because of all the competition in that industry. And the only thing the DeFi protocol wants is more capital in the DeFi protocol. So nowhere in that collection of wants is anyone saying it's absolutely critical for us that, my parents or your parents go through the 15 steps to use Aave on like the website. Like nobody's, I don't think that's really that important that they do it that way. It doesn't matter. And I think that's not how a lot of capital is going to flow into these things. I think it's like a back end technology is what I'm saying. It's not a front end technology. If somebody builds like a fantastic user experience for DeFi and they just get a huge amount of users from Web 2, like great. That's really impressive. But think about who they would have to compete with, right? They would have to compete with PayPal's user experience. They'd have to compete with Robinhood's user experience. They'd have to compete with every bank's user experience. They'd have to compete with every mobile and web application that wants to have people give them their money. So this means load times. This means all the user flow stuff for clicking a button. This means a ton of stuff, right? That's not actually what crypto is about, right? Crypto is not about creating a more efficient, faster loading, mobile first user experience for you to part with your money and gamble on the value of Microsoft stock, right? Like that's that user experience thing. This whole place has totally sucked at that from the very beginning, and it's still very bad at it. I don't think it's going to get very good at it. I think what's going to happen is that if you can legally get all of that through your existing user experiences, you will get it through those user experiences because those user experiences will want to give it to you. Does that add up for you?
Yeah, I mean, I think in terms of getting actual adoption, you want people like my parents to use an app that they are unaware of the fact that it's actual blockchain. It's completely irrelevant for, I think, like 90% of the world, whether it's something is blockchain or not. It becomes more relevant if there is a certain when there is a certain need for self-custody. That could be a reason, or indeed providing a yield. And in the case of the banks, well, banks are relatively have been struggling to make money. And then if DeFi comes in, they have a larger margin. So there's also a use case, which brings it again into some sort of perfect storm where TradFi meets DeFi, and can
Yeah,
connect to each other.
I don't think it's TradFi against DeFi.
No, no, no,
I
no.
think TradFi and DeFi are each other's biggest customers. And this is what we in the Chainlink community have been saying and building towards for the last 7 years, like pretty much from the beginning. The thesis has been very clearly, how do you get all of the money over there in the traditional financial system to come over here into the blockchain system? How does that happen? Right? That's a very basic, very important question. I think this whole like, let's kill everybody, let's kill the banks. I mean, yeah, you could try to do that, I guess. I mean, it's going to be pretty tough because they have the law on their side and they have all this money. The more likely outcome is that it's like the internet, right? The banks that go along do well, and therefore they are the way to do a bank, right? What is the way to do a bank now? It's to have a website, emails, digital cash transfers. Everybody's logging into web interfaces in order to manage their relationship with the bank and with the asset management firm and so on, right? Like imagine an asset management firm that was like, we don't have a website. We don't have a website. We just, we'll send you the statements and you can call us or you can call your broker and we'll get on the phone with you. And that's what we'll do. We won't have any website. We won't put anything on the internet. We won't do it. It's not for us. The internet's not for us. That shit doesn't exist. So that's basically where it's going to end up, is that there's going to be some people from DeFi that survive because they're very reliable, like Aave and others, that are the ones that people that's like the JP Morgan of DeFi and the most reliable version of something, because reliability is very valuable because of that risk reward dynamic we were saying, right? The reliability of a system in this context is very valuable, both from an uptime and a security point of view, because of the the perception that has on risk, or actually the effect, not even just the perception, but the real effect it has on risk, which then leads to a perception, which then leads to a decision about whether or not to allocate capital to that system. And then a lot of the people that are going to benefit from this technology, I don't know what to tell you, they're going to be entities that decide to get on the bandwagon sooner, like BlackRock and others that have done that, right? And that's what's going to happen. They're going to be talking about how they always believed in blockchains, how they did it from the beginning, and it was them and Satoshi having beers, planning it out and doing it together from day zero. That's what's going to happen. Just like you ask any firm, what's your relationship with the internet? Oh, we were one of the first firms on the internet. We love the internet. The internet and us like this. I'm positive. You go back in time 30, 40 years, if that firm existed back then, you're like, what's this internet thing? You'd meet a million people that'd be like, oh, it's nothing. For the post office. Email. That's it. This is it, right? I still don't get why people don't see this as clear as day, but that's the situation, right? It's not going to be DeFi kills TradFi. It's going to be DeFi and TradFi work together to make a new global financial system. That's what's happening. And our goal in that whole dynamic is to be a key part of the infrastructure that powers that from a protocol point of view and from a standards point of view across financial market infrastructures, across blockchains, across use cases. So existing financial market infrastructures, existing systems can interface with the Chainlink standard and CCIP and the data feeds and everything. And they can basically accelerate how quickly they are enabled to be on chain. That's basically the main thesis of Chainlink at this point as a community, is to enable that.
OKX is the first crypto exchange to get the MiCA license in Europe. To celebrate this milestone, they are running a campaign for new users where you can get up to 50 euros back in Bitcoin for relatively simple tasks. You can check the details in the link below. On top of that, they also have the lowest fees and publish their proof of reserves, so you know your money is safe. If you're still looking for a crypto exchange, sign up to OKX to receive the welcome bonus and start trading with the lowest fees. It reminds me of a video that I saw the other day where people I think it was somewhere around 2000, or maybe a little later, were asked about mobile phones on the streets, whether they were going to use a mobile phone or not. And I think like 90% of the people said, yeah, why would people want to call me at any day in any moment in time? Like, no, I'm going to leave it behind. And now we're all like attached to our mobile phone and everything becomes interconnected, where physical offices of banks have been erased and everything has become digital. And on top of that, I think in one of the other interviews that I saw from you, there was for some people, relatively wild statement that the markets of RWA or industry size is going to be surpassing the crypto markets as a whole. Why do you think so?
Yeah, well, there's two quick things. The first thing is on mobile phones. I hate mobile phones. I totally hate those things. They are the thing that are killing people's attention span and making everyone significantly dumber, in my opinion, because they're constantly distracted and unable to sustain a thought. It's a very bad situation, actually. But
in that regard, I think what's good, people are in Australia, if you're 16 years or younger, you're not allowed to be on social media. I think it's a new law that started like in the past 3 months.
Something like that. I mean, social media is a whole other problem. Social media is like a whole other, psychologically debilitating situation. That's a whole other. The mobile phones are its own thing. And mobile phones are a great example, right? So me, as someone that doesn't like mobile phones, I avoid mobile phones because I prefer to just actually think about things. I like to avoid distraction, and I like to think through a problem in in a methodical kind of way that can be pretty time consuming, and you can't constantly get pinged about things. But even people like me have to deal with mobile phones. We have no choice, is my point, right? Like, I don't like mobile phones very much, but I have multiple phones. I have people pinging me on all kinds of messengers. Even now, if we're chatting, I have the chat message window open there on the bottom right. Should probably just like get rid of it. I'm still, yeah, there you go. I'm covering it up with this one. That's going to do it. That's going to change my life. But it's still there, right? So I think what happens with technology is very simple. If you want to be productive and you want to interact with other people and you want to take part in the market and you want to participate in the world, you basically have to adopt certain technologies, right? Like, you have to be on email. You have to message with people now, especially if you work in Asia. In Asia, nobody uses email. Everybody's on like 3 different messengers, right? Nobody even does email. You tell people, let's email. They're like, I don't know what you're talking about. Like, let's use some messenger app to conduct our conversation. You have no choice, right? That's really kind of the thing with technology that's a little bit maddening. If you want to participate in society, if you want to participate in markets, you have to adopt technology to a certain point, right? Which actually kind of, interestingly enough, also brings us to an answer to the other question that you mentioned or you asked about RWA. Let's ask ourselves how much speculative interest there is in synthetically generated cryptocurrencies, that many of which are like meme coins, right? So how much speculative activity is there to do meme coins, right? What is that universe about? How many trillions of dollars will people want to put into things that are not connected to anything, right? Many cryptocurrencies are not connected to anything. Some of them are, right? Some of them are utility tokens to use an infrastructure. Some of them are like Bitcoin that are viewed as digital gold and a hedge against fiat currencies, so that thing has a thesis. So the real question is, how much value is there in the world to put into cryptocurrencies? Because many of them are speculative and, some of them are related to infrastructure. And then there's Bitcoin, which is its own class of things. Let's take whatever we think that number is. Say that number is, I don't know, $10 trillion. Then let's take all the other assets in the world, all the real estate, all the gold, all the equities, all the commodities, all the other assets. And let's ask ourselves a simple question. Is the ownership and transfer and management of all of those assets going to be done better in a blockchain-based format? Or will it be done worse? If the answer is that all the real estate, all the gold, all the commodities, all the equities will eventually migrate into a blockchain format, then the question you're really asking is, do I believe that real asset ownership is going to be larger than speculative asset ownership? I think the human tendency to diversify towards some class of speculative assets, like Bitcoin and a meme coin and an NFT and something else, is not that large. I think on average for everybody's portfolio, it fluctuates between like 1 to 20% at the high end. The rest of everyone's portfolio, the rest of everyone's assets are stable things, right? Real estate assets, gold assets, equity assets, commodity assets to hedge inflation, maybe utility token assets as a representation of an infrastructure and the role that infrastructure plays. but stable real things. Those stable real things have always been a much larger share of the world's value and portfolios and assets and what people place their money into. So that's really the question, right? The question isn't, are cryptocurrencies better than RWAs? It's just like, do we believe that all the real world things will become tokenized and blockchain based eventually? My answer is yes. Yes. All the real estate, all the gold, all the equities, all of it. Refactoring of invoices, insurance claims, revenue from ad networks, revenue from entertainment, all of it will be tokenized eventually over the next 3, 4, 5, 10 plus years, depending on the industry. And then if you believe the answer there is yes, the only question is, do I believe that everybody's behavior towards their portfolio and asset management will shift from 80% stable assets to 80% speculative assets? Like everyone just becomes a degenerate gambler and starts buying meme coins with 80% of everything they own, including the sovereign wealth funds and the senior citizens and like the most conservative people in Switzerland, right? They all just say, I don't believe in real estate and gold. I'm taking 80% of my net worth and I'm dropping it in meme coins. Okay, if the answer to that question is yes, then cryptocurrencies and NFTs and meme coins can eclipse real world assets. The answer to that question is no. And the answer to the previous question is yes, everything will become a tokenized real world asset eventually. Then I think it's very logically very obvious, right, that we will arrive at a world where when you add up all the stable coins, gold coins, real estate tokens, tokenized funds, tokenized equities, I mean, we don't even really have high quality tokenized equities yet. You understand how early that is for us?
I do know that a certain exchange has tried it.
Yeah, exactly. But it's hard to yeah. I mean, they've tried it. A few of them have tried it. Even regulated ones have tried it, but never went anywhere. Why? Because of regulation, right? So I think if you logically just reason it out, it's pretty obvious to me that real world assets will eclipse cryptocurrencies as long as those two things are true.
Mhm. And I think they are really well connected to each other. And going back to your portfolio statement, I think in the Web3 space, there are a lot of degens that have a very speculative portfolio. And I think a lot of Web2 people indeed have the stable portfolio. But if I look at myself, I think there are certain limitations to going from crypto towards, let's say, a real estate property. And I think tokenizing everything is making it more efficient, more liquid. You can transfer value basically. So that's ideal if I can just stay into something that's tokenized and just transfer and trade whenever I want, and that I don't need to wait for like 6 to 12 months before my property is going to be sold. Or I need to pay a ton of fees to buy any commodity out there. And in that regard, I think there's a very nice connection between RWA and crypto. And RWA, for instance, is way larger. But I wanted to come down to the question of there are certain additional factors that we need to take into account. And then my question would be, how is Chainlink going to serve that transition or the merge? What is Chainlink's role going to be?
Chainlink creates a set of protocols and standards that allow all of these systems to operate in a way that creates the ability to tokenize, creates the ability to make the RWAs, creates the ability to move the RWAs across chains. It enables DeFi. So Chainlink powers the majority of DeFi right now, and it has since inception, because Chainlink provides, in DeFi's case, the data feeds that allows it to come into existence. So Chainlink is kind of like the pipes under a sink, basically. So the reason that it's difficult to understand things like Chainlink and blockchain infrastructure in general is because it's underneath the surface. It's like the wires and the cables and the pipes underneath the street. And people don't really think about that stuff, right? What they think about is that there's electricity in the lamppost or there's water in the sink. And that's the thing they interact with. That's what they mainly understand. But if you didn't have electric wires and you didn't have those pipes, you wouldn't have electricity in the lamppost and you wouldn't have water in the sink or wherever you needed it. So what Chainlink does is it basically enables the flow of data, the flow of value between all of these systems. So it integrates the old systems like Swift and existing CSDs into blockchains. It integrates the blockchains with each other. And it integrates all the data systems and all the custody systems and all the various other systems that need to exist for all of this to work, basically. The way to think about it really is when you take the internet, there's a set of protocols that allow the internet to work, like TCP/IP, for example. TCP/IP, HTTPS, POP, IMAP for email. These are the protocols that allow you to have email, access to websites, and the transmission of information on the internet. If these protocols were not standardized across the internet wouldn't exist. What would happen would be there would be multiple internets, like there was in the beginning of the internet's development. You would have multiple separate internets, and that's actually eerily similar to what you have now, where you basically have multiple chains that are like they're multiple internets. And then you have what I would consider like legacy internets, which are existing payment systems and existing CSDs and existing other traditional finance infrastructures that are very closed. And the challenge that we need to solve is how to get all of these systems interoperating. How do you get the old systems that have all the money in them? How do you get the new systems? How do you get the data from the old systems? How do you get the data from the new systems? How do you get all of it to interoperate so that you can do a transaction? Maybe let me explain how a transaction works, and that'll clarify.
Sure.
So the way a transaction works in the public blockchain world on a single chain is very simple. It's I sign a transaction to send you a token like an NFT or some cryptocurrency or something else, and you receive it at your address. That's it. It's very simple, right? There's no need for identity. There's no need for connectivity between blockchains. There's no need to interface with any existing system. You sign something with a private key. If you're one of those power users that went through the whole crazy experience of getting a private key and having it and clicking the buttons and doing everything, and you're done. What does an advanced blockchain transaction in this new world we were discussing looks like? Well, I'll tell you what it looks like. There is, like, for your parents to own something, or for someone else that doesn't have, the device, the ledger device or the Trezor device. Okay, I've logged in to my traditional system. I click a button. I tell my traditional system I want to get this asset. Okay, great. That traditional system then needs to communicate with a blockchain somewhere. Okay, Chainlink helps with that. Then that traditional system needs to value that asset, needs to assess the asset, needs to make a decision about the asset. Whether it, meets their risk requirements, what the price of settlement will be, all these things. Chainlink data comes in there. Now you have to actually sign and buy for the asset. Chainlink is used by many of the systems that facilitate that. So basically, now you go buy the asset you have. But it turns out that the way all this actually has to work is that asset has to be held on some other chain. So maybe the asset is on chain number 5,627,000, and it doesn't have to stay there. It has to go somewhere else. So now the asset has to go to another chain. Okay, well, now you need CCIP, which is the TCP/IP equivalent of Chainlink, where you move it from one chain to another chain. Okay, great. Now it's moved to this other chain. But we still didn't handle the payment. The user still has to pay for the asset. Okay, that's another flow. Where are they paying in a central bank digital currency? Are they paying in a SWIFT payment? Are they paying in a stable coin? In all three of those cases, you need to instruct the payment. You need to move that payment probably across chains. You need to provide all kinds of identity information, price information, all kinds of information. So the base transaction in a blockchain, just between you and me in the same blockchain, is literally 1 to 3 steps. It's pretty simple. The base transaction in this advanced next generation world that we were talking about earlier is like 10 to 20 steps, depending on the asset, depending on the payment method. All of those steps can't happen without something like Chainlink. They just can't happen. So either you're going to have to use Chainlink or you're going to have to replicate what Chainlink does. And the problem with replicating what Chainlink does is that if you build your own version, then the other people won't be on your version. They'll be on the official Chainlink version, just like everyone is on the official version of TCP/IP. And all the websites are served through the official version of HTTPS. And all the emails are sent over the official version of POP and IMAP, right? This is basically the role that the Chainlink is playing. It's creating those pipes, it's creating those electric cables that allow all the other things to work. And everyone has to get on a single way for all of that to work in order for it to actually work. You for example, in the case of electricity, you had a whole big debate in the early days of electricity about AC electricity versus DC electricity. So there were 2 types of electricity. Eventually, everybody went with one type, right? Everyone eventually went with one type of transmission protocol for information on the internet, TCP/IP. This is what Chainlink's goal is, and this is what the Chainlink community means when they say that Chainlink is going to be a global standard. It's that if you do a transaction to buy an asset from a big asset manager, in the back end, there's going to be about 15 steps that you don't know about, but that have to happen, and they all have to do with data, identity, cross-chain connectivity, various forms of computation that blockchains don't and can't do. It's kind of like talking about, let me explain to you how the transformer works a few blocks from your building in order to explain, the value of a light bulb. That's kind of the level of abstraction that Chainlink is at, and why sometimes it's not fully understood. But the important thing about Chainlink is not that it's fully understood by every consumer, just like consumers don't need to know how transformers work. What's important is that Chainlink delivers the security and the reliability that's necessary for those transactions to happen. The system that allows those transactions to happen by injecting the relevant data, creating the connectivity, doing the relevant computations that can't be done on chain, that system is going to be the thing that I think pushes the edge of what's possible in our industry. That's what I think the Chainlink community is excited about building. That's what I'm excited about building.
I think that makes a lot of sense. But to grasp or to get a certain understanding of CCIP, which type of real-world use cases connected with CCIP do excite you the most at this point? That people understand.
Sure. So let's say a big asset manager makes a tokenized fund about, let's take something interesting, private equity or real estate. That private equity or real estate tokenized asset is generated on blockchain A. It's generated on some blockchain run by the asset manager or a public chain or some chain. It's generated over there. The user has their money in blockchain B. They have their stablecoin, central bank digital currency, tokenized cash, whatever. They have their form of payment in blockchain B. The user doesn't want to know or care about blockchain A or B. It's not their problem. They don't give a shit. They just want tokenized asset about private equity, because the private equity fund invests in genomic healthcare, and the user wants to buy exposure to genomic healthcare, or they want to buy exposure to a specific building because they think it's in a nice area because they walk by the building every day, but they don't have $100 million to invest in the building. They only have like $1,000. Long story short, that tokenized unit of stuff that the user wants, the piece of real estate, the private equity, the tokenized fund, is over there. Their payment is over here in blockchain A. What CCIP does is it enables a connection between blockchain A, where their money is, and blockchain B, where the asset they want is, to do something called delivery versus payment, DVP. Delivery versus payment is very simple. It's I will pay you, you will deliver something to me. In this case, the tokenized payment, the cash, the stable coin, the central bank digital currency. And in order for that to happen, in order for you to buy that piece of real estate, in order for you to buy that private equity fund ownership, you need to prove certain things to the token issuer. You need to prove your identity, for example. If you don't prove your identity, they legally can't sell it to you. They can sell you some Bitcoin, but they can't sell you that. They can't sell you the thing that you want. And you already have Bitcoin, so you really want this other thing. You want the tokenized real estate, and you want the tokenized private equity fund about genomics, or you want the tokenized whatever you want. So what CCIP does is it forms a connection, and then it pulls in all the necessary data to facilitate and enable the transaction. Identity data, price data, proof of reserves data. For example, your financial services provider might have a condition that they want to check that the token that you're going to get actually is backed by something. In which case, that token should have something called proof of reserves, which is a system that Chainlink makes. It's the longest running, version of the system, the most widely used. So that's an example of a piece of data that if you were doing this right, you would have your system, your bank system or mobile fintech app would check that the token you're getting is legitimate, because the token would have proof of reserves, and the proof of reserves would prove that the token is indeed connected to the value that it's connected to. Then you would need to prove identity. Then you would need to probably define a price in order to tell you how much you should pay in the stable coin. Then your system would decide, to do that. And then it would send the identity information. It would send the payment. The identity information would need to be encrypted so that it's not public, but still usable. We do that through something called DECO, which is a complicated zero-knowledge proof solution. This is an example of me explaining to you how the copper inside of an electrical wire works and why one grade of copper is better than another. But, that's a whole other thing. And now you've sent the payment over to blockchain B. You received the asset back into blockchain A. So now you have the asset in your address on the blockchain that has your account. And now you might need to go into a third step where your financial institution might want to put that asset into another blockchain, a third blockchain, a custodian chain, because they want to hold that asset in a custodian environment, because they want to do that by law. So now they take the asset from blockchain A and they send it to chain C, custodian chain C, because by law they have to hold the asset there, or they want to hold the asset there. So now to buy this advanced blockchain asset that isn't being Bitcoin, it isn't a meme coin, it isn't an NFT, it's a $1,000 unit of the building in downtown that you would have never been able to invest in. except we tokenized it and we give you the ability to buy $1,000 worth of this building. Or, the private equity fund that only the richest people can invest in, but now you can buy $1,000 in that because you believe in genomics, or, maybe you're a genomics researcher and, you believe in mRNA expanding to have us fly or whatever. So now you've done this transaction, you've gotten your asset, you had to go through 2 to 3 chains. You had to send a bunch of data. You had to send that data in a secure way with special forms of encryption like zero-knowledge proofs. And you had to do all that in a way that the people on the first chain and the people on the second chain all agree to do it that way. You see? So blockchain A, the contracts on blockchain A, the contracts on blockchain B, the contracts on blockchain C, all have to communicate and send all this data and send all this value to and from each other in the same way. They can't be on different forms of electricity, right? One of them can't be on DC electricity, the other one on AC electricity. They all have to be on the same wiring in order for them to do all of this transfer of value and transfer of data. If they're not on the same wiring, they can't transact. That's it. This is what Chainlink does. And the big difference between Chainlink and many other systems that try to do a portion of what Chainlink does is that A, they're much less secure, and B, they only do a portion of it. So Chainlink is the only, you could say, platform that in one set of protocols can do all of the things I just said to you. It can send the price data to settle. It can send the identity data. It can verify the proof of reserves. It can move the payment. It can receive the asset. It can move the asset somewhere else. It can prove all these things to all of these different systems. It can integrate with the legacy systems of everyone on all those chains so they can interact with all the contracts and they can interact with all the data. They can interact with all the other chains. Right now, at this moment in time, there's no system that does that collection of things at the same time. And this is why my view of Chainlink has evolved from Chainlink is a protocol for data, or Chainlink is a protocol for cross-chain, or Chainlink is a protocol for identity, or Chainlink is a protocol for off-chain computation, or Chainlink is a protocol for synchronizing with AI and blockchains. On to Chainlink is a set of standards that developers can compose into complicated, advanced blockchain transactions. You see? This is not about just delivering a piece of data, and it's not just about delivering a piece of identity, and it's not just about creating a connection. It's about being able to do all of those things at the same time to create an advanced next generation blockchain transaction that is compliant with various laws, that is able to interface with all the different chains, and that is able to interface with all the existing systems, including all the data systems and all the legacy backends that control all the money. You really can't do all of that with something other than Chainlink right now. And if you try to, you're going to have to do it with like 3 different startups or 4 different startups that don't want to work together and don't work together. And you're going to have to build 3 or 4 other things that they don't even have. So the standards that Chainlink creates, that the Chainlink community has invested massive energy and time into, are basically becoming now the way to do a transaction that is more advanced than I send you coin, you send me coin on the same chain with no other data. And my view is that the vast majority of blockchain transactions will eventually be those advanced transactions. There'll be transactions that are compliant, that have identity attached to them, that are going across chains, that are deeply integrated with existing systems like Swift and Fix and various bank backends. That will be the vast majority of blockchain transaction volume. There will still be transaction volume within blockchains of like, I send you a coin and you send me a coin. That'll exist. But I don't think that'll be the majority of blockchain transactions. I think that that'll end up eventually being a small minority, and the vast majority will be across chains initiated by existing systems utilizing multiple pieces of data in order for them to happen.
I think that was a very clear and comprehensive explanation of what CCIP and Chainlink does. I think we've been touching upon many topics, and I'm sure there are way more, but I've been part of your, well, multiple conversations you had with Stani back in October in Singapore. I think you had back-to-back sessions with him there. Um, and during that conference or those conferences, I think the central topic was also the macroeconomic environment, which has partially changed given that the US has done a 180. But then, secondly, we also have the US government bonds having relatively high yields on them that has had its impact onto DeFi in general. There are certain expectations going forward, but what's your expectation going forward if, let's say, the yields are expected to decline? Could that be the catalyst for DeFi to unlock the next 100 billion?
Yeah, absolutely. So I think what's likely to happen is that DeFi will have a continual revolving door of companies and startups that create increasingly risky, high-yielding assets. That set of risky, high-yielding assets will always find a market. I think that market is much larger than it is right now. And part of it is the usability problem that you described earlier of people being able to use DeFi easily. That usability problem will get more and more solved, and you'll have a continual revolving door of firms that make high-risk asset types. That'll grow DeFi in and of itself, right? Separately from the dollar yield world. I think the dollar yield world, you still earn right now significantly more yield on the US dollar when you put it in DeFi right now. As long as that continues to be the case, DeFi will continue to grow. I think the big unlock for DeFi to grow will be two things. It'll be the risk assessment of DeFi by very large capital holders, which will boil down to a technical assessment of it, which will include the security and reliability of Chainlink Oracle networks, which have been operating successfully for over 5 years through congestion, flash loan attack attempts, through all these things that affect other systems, but not us, but not the Chainlink infrastructure. So one dimension of it will be evaluating the actual risk of DeFi, which will boil down to the technical risk of DeFi, much less than the brand association or the brand behind the DeFi protocol, because that's fundamentally how DeFi works. The second big unlock will be regulatory clarity and regulatory approval to put client funds and asset management funds into DeFi protocols in a legally compliant way that does not create legal risk for the asset manager or financial advisor. That is the big barrier, the big legal barrier. If financial advisors and asset management firms can give their client base 2% more yield on a stable, widely held asset like the US dollar, and they can do that legally without any legal risk to them, that's, I think, a fantastically valuable value proposition that they'll be very eager to do. They're very eager to do. I think that hasn't happened partly because they've just now really started to understand the technical risks of DeFi, which is good. Because when you look at DeFi from a brand point of view, it's a little bit confusing, right? You have all these newly formed companies. They have DAOs. Their Twitters have all kinds of crazy things going on. They have names that are not well-known names in like the Web2 traditional financial markets world. And as a brand, they look like new and risky, basically. But if you evaluate them from a technical point of view, and you actually do that evaluation, you find that they're much less risky than CeFi systems that can just do whatever they want, or various other systems that have a tendency to fail and are built in really weird ways. Once the financial markets evaluate DeFi from a technical point of view rather than a brand point of view, and once it is legally accepted and legally de-risked for those clients to put their money and those financial advisors to advise their clients to get their yield from DeFi, I think it's gonna grow very, very rapidly. Like I would not be surprised at multi-trillion dollar DeFi in a number of years if these things happen. I can fully see that happening based on the amount of value that that people have in the financial system that they manage for other people. I mean, you just need to look at the numbers. Like a few $1 trillion in DeFi will not make a significant dent on the asset management industry globally. It'll be a very small portion of that.
And if we're going to basically unlock the next level or the next stage of DeFi, what are the key goals for Chainlink for the upcoming, let's say, 1 to 2 years?
Security and reliability are always at the top of the agenda when we're discussing what the goals of Chainlink are, in my opinion. That sometimes creates some delays because building a secure, reliable system is significantly harder than building an insecure, centralized, unreliable system. But in my opinion, the conversation about Chainlink's goals should always be around how do you make the secure, reliable version of a bridge? How do you make a secure, reliable data feed? How do you make a secure, reliable identity transmission system and identity synchronization DID type system? Because if we're talking about trillions of dollars will not happen without a highly secure and reliable infrastructure over which the data and the value moves, right? So the first condition of what Chainlink should be doing, in my opinion, is to be secure and reliable, or as secure and reliable as possible, and outside the realm of like what other people are doing. There's lots of people making all kinds of bridges that constantly get hacked. There's lots of people making all kinds of oracles that constantly get flash loan attacked, and people have money stolen from them. That shit still happens on a regular basis, and it doesn't happen to Chainlink because security and reliability is what global infrastructures are built on, right? Swift is built on security and reliability. The AWS ecosystem is built on security and reliability, so on and so on, right? So that's important. The next category of things that Chainlink should be doing, in my opinion, is creating a larger and larger collection of decentralized microservices. So the way that developer frameworks and developer infrastructures get adopted is that they have libraries, or in Ruby, on Rails' case, it was gems. And JavaScript, it was libraries. It basically prepackaged little pieces of code that let developers do things without having to build anything. Basically like tools in a toolbox. Chainlink right now has over 1,000 Oracle networks live on production. It has the largest amount of different microservices. So with Chainlink, you can get a random number, you can get identity, you can get weather, you can get market price, you can get connectivity between chains. You can do connectivity to legacy systems. You can do connectivity to AI systems. Like no other system has as many different libraries or abilities to compose an advanced smart contract, right? So I think Chainlink should continue to generate all the most useful Oracle networks, decentralized microservices, which are effectively going to act as libraries because they're pre-built pieces of code that solve a fundamental problem in the development of a smart contract, right? So generate the libraries, scale the ones that already exist. So more data feeds, more streams, more cross-chain connections, but create additional new types of libraries around the usage of AI by blockchain, so on and so on. And then the third thing that I think, and the libraries, by the way, include connectivity with like Swift and Fix and all the different existing systems. Like Swift usage through Chainlink from blockchain A to blockchain B is an example of an Oracle network and basically a library that's now possible, right? That's what that is. So that all of that legacy integration work is there in the second group of things. The third group is to create a developer experience that makes building these advanced smart contracts easy for developers. Right now, it's not easy. Right now, if you want to build one of those smart contracts that I told you about with the 10 to 20 steps, where you go across 2 or 3 chains, you have to inject identity, you have to inject price, you have to proof of reserves, you have to all this stuff. You basically need to integrate with 3 or 4 different Oracle networks from Chainlink. You need to write different pieces of code on one chain. You need to have your off-chain system control that code to do things. It's a lot of stuff. It's a lot of stuff to manage. And you can't prove a lot of it to other people because sometimes it's code that you wrote privately and it's off-chain, which is not really how this whole DeFi blockchain-based thing is supposed to work. The third category is where you basically need a new environment to compose all of the different things that are needed to make an advanced smart contract or an advanced blockchain transaction. This is the CRE, the Chainlink runtime environment. So the Chainlink runtime environment seeks to play a similar role to what the Java runtime environment did in the 90s. When you hear about banks and the financial system basically running on Java, it's because the Java runtime environment made it very easy for developers to build financial applications in the web world by getting a lot of libraries to work together in one place with one piece of code, managing all of that and making it all work in a more or less manageable, secure way. That's why Java is popular, right? The Java runtime environment and all the libraries and things that it has associated with it. So the good news for Chainlink is that it's very secure and reliable and has a track record of being secure and reliable. And our community has made a very thoughtful investment in effort and time to do that. That's why for over 5 years, Chainlink has been by far the most reliable. It's why the majority of DeFi is on Chainlink. It's why it's viewed as the most secure and reliable system of its type by far. So great news on that. Largest amount of libraries of multiple types, more multiple types of libraries in the works and coming out regularly, more and more scaling of the existing libraries. So the Chainlink ecosystem has the most libraries, the most capacity to give you everything in one system. The identity, the data, the proof of reserves, the connectivity, the legacy system integration, all in one place. Basically expressed through these individual pieces of code. Now you need to take those individual libraries and pieces of code and you need to compose them easily, right? Ideally, what you would do is you would write one piece of code, one piece of workflow code that basically defines what's going on. Here's my primary smart contract. Here's my secondary smart contract on the other chain. Here's what I want to be able to do from Swift. Here's what I want from a data system. Here's how the identity system interacts with my thing. You define all of that in one piece of workflow code. And that piece of workflow code in the CRE manages all of that complexity. So now you want your tokenized real world asset to be issued on blockchain A, and then you want it to be purchasable from 50 other chains. And you want 20 of those chains to provide you with certain identity information, because those 20 chains are in countries or from banks that have identity requirements. The other 30 chains, you want some other data from them because they're in another 30 set of countries or 30 set of places or chains or whatever that have a different way of doing it. And by the way, whenever you sell a token, you need some price data to tell people what it costs. Oh, and you want to have proof of reserves for your token because you want to prove that it's actually backed by something. It's not just, a meme coin. Okay, wow, that's a lot of stuff, isn't it? I got to get a token live on a chain. I got to get it connected to 50 chains. I got to get a bunch of identity data working across 50 chains. I got to get a bunch of price data working to sell the token actually. I got to prove things about the token, and I got to make all that work. Wow, okay. Here's a single piece of code that defines all of that complexity. It pulls on all the different libraries that manage all that complexity for identity, for cross-chain connectivity, for price data, for proof of reserves, for, whatever else you need. Let's say your token needs to get rebalanced and you made an AI model to rebalance your token. Great. Your AI model runs over there, but you need it to interact with it too. That's another thing, right? More and so on and so on. The CRE is the environment that's getting built by the Chainlink community to make it easy to do that. So building something like what I just described would take months to years, depending on the bank you were working with or the group you were working with. In the DeFi world, it would take months. Banking world, it might take a year plus, if you're lucky. With the CRE, what we want to do is take it down to days and eventually down to hours. Because there will be a piece of code that does that. So once you make one of those tokens that works across 50 chains and that gets all the identity data and gets everything working, and once you connect that token to your existing custody solution, like Fireblocks or Taurus, to manage it, you can do it again and again, right? You didn't just launch one real estate token that's integrated with your custody provider, and that's integrated with Swift for payments, and that's integrated with all the 50 chains, and that's integrated with the identity system. You can launch 100 more tokens now using that code. You don't need to redo anything. You just, make more tokens using that code to manage that complexity. This is what ideally would happen with the CRE. And the reason we're building the CREs is basically because our community and me and others have so much experience building these advanced blockchain transactions and advanced smart contracts that from our point of view, we just decided even for ourselves, like, I really don't want to write these 20 pieces of code to make these 10 blockchains do what I need with some data and some identity. I just don't want to do it. Like, it's so much work. Mm-hmm. Really, right now, the CRE is already being used for some of our work with some of the larger institutions and financial market infrastructures. And the rate at which engineers have been able to build some of those things is, in my opinion, like 10x faster than what they would have done otherwise. I've built a number of those things with engineers in the past, and the amount of time and the speed at which the engineers were able to build, the CRE implementation was, from my point of view, much faster and much simpler than when they had to make 20 pieces of separate disjointed code. By the way, nice additional property here. Those 20 pieces of disjointed code that you write privately for your advanced smart contract to work across the chains and across all that data and identity systems, you can't ever show that to anybody because it's running, in some server you have somewhere. Like, it's completely centralized, and you can't prove it to anybody because you just built everything that Chainlink does and you stitched it together in your own code. And you can't show that to anyone. And even if you show it to them, they can't trust it because it isn't audited or no one else has used it ever. So they don't even know what it does. But you could show somebody CRE code, and you could show them through the CRE code, the workflow code, oh, this smart contract does exactly this. Does exactly this. Here's how it relates to data. Here's how it relates to identity. Here's how it relates to Swift. Here's how it relates to these 50 chains. Here's how it relates to the AI. Here's how it relates to this. And then you can provide a guarantee that that workflow code is going to function that way. It's not going to function some other way. You see?
Mm-hmm.
So basically, the CRE is creating this kind of overlay to define what an advanced smart contract across chains is and what an advanced blockchain transaction across chains is. And this is great for the chains because they'll just get more traffic, right? They'll all get more usage, they'll get more adoption, but there needs to be something that coordinates this complexity across chains, across data systems, across identity systems, across legacy systems into a single piece of workflow code. And this is a common dynamic you see in infrastructure. Like Terraform is a good example from the web world, where it became extremely popular because it coordinated the complexity of multiple clouds through a single system, basically. And it also has a number of valuable integrations that make it useful. So this is a common pattern. Mm-hmm. Chainlink is basically trying to follow that pattern in a very secure, reliable way, right? Secure and reliable, maximum amount of feeds and services and microservices, and the maximum amount of ease of use, if that makes sense.
I mean, again, that's a very comprehensive answer, and I think that the journey of Chainlink has been amazing. I think the journey of DeFi has been a bumpy ride, but it kind of fits like everything is currently getting into the perfect storm. So I'm really looking forward to what Chainlink is going to bring towards DeFi, CeFi, TradFi in the coming 1 to 2 years. And I really want to thank you for being part of the podcast. And as we discussed, you're primarily going to be focused on the US, which is currently opening up for everything within crypto to be adopted. And I can fully understand that. I mean, there are so many exceptional opportunities that are probably once in a lifetime. So good luck with that. I would love to have you on the show in 1 to 2 years from now to see how far we have progressed, what has been happening, what Chainlink has been doing to evolve the Web3 ecosystem. But thank you very much. Are there any final thoughts you would like to share to the audience? Or
yeah, it's been my pleasure. Good to see you again. Glad we had another chance to chat. I mean, my final thoughts are, if you're choosing between the AI industry and the blockchain industry, and you're really, really smart, you should choose the blockchain industry, is my advice, because it's going to be a very big deal, especially if you're interested in financial applications.
Well, I think the two are going to be connected anyways.
Yeah, hopefully through Chainlink.
All right, thank you very much, Sergey.
Great to see you. Thank you.